The market is not your enemy. It is a mirror, and what it reflects back to you depends entirely on what you bring to it. Most people bring fear, greed, impatience, and a desperate hunger for quick returns. Benjamin Graham spent a lifetime teaching the world a different way, a calmer way, a more disciplined and ultimately more profitable way of thinking about money and markets. His book, The Intelligent Investor, first published in 1949, is not simply a guide to buying stocks. It is a philosophy of life disguised as a financial manual. It is a letter written by a wise and patient teacher to every anxious investor who has ever stayed up at night wondering whether they made the right decision, whether the market will recover, whether they should sell now or hold on just a little longer. Graham's answer to all of those questions is elegant and timeless. Think like an owner, not a gambler. Think long-term, not in the next quarter. Think about value, not price. And above all, think. Benjamin Graham was born in London in 1894 and grew up in New York during a time when financial markets were far less regulated than they are today. He watched the great crash of 1929 wipe out fortunes, including a significant portion of his own. Rather than walking away from investing in despair, he did what only the truly curious and resilient minds do. He studied the wreckage, analyzed the causes, and built an entirely new framework for how rational human beings should interact with financial markets. His framework did not rely on tips, trends, or timing. It relied on something much more durable. It relied on logic, patience, and the careful study of a company's true worth. The book he eventually wrote became the foundation upon which modern value investing was built, and it produced one of the most famous investors the world has ever seen, Warren Buffett, who has repeatedly called The Intelligent Investor the best book about investing ever written. The book opens with one of the most important distinctions Graham ever made: the difference between investing and speculation. This distinction is not merely academic. It is the difference between building lasting wealth and gambling your financial future on the hopes and fears of strangers. Graham defines an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. He is precise and deliberate in this definition. An investment requires analysis, not intuition. It requires the promise of safety, not the hope of safety. And it requires an adequate return, not a spectacular one, not a return that makes you feel clever, but a return that compounds steadily over time and protects your purchasing power against inflation. Everything that falls outside this definition, Graham says with characteristic bluntness, is speculation. Most of what millions of ordinary people do in markets every single day is, by Graham's definition, speculation. They are not investing. They are guessing, and they are paying brokerage fees and taxes for the privilege of guessing wrong, at least as often as they guess right. The distinction matters because it changes everything about how you approach the market. A speculator watches the ticker every hour. An investor reads the annual report once a year. A speculator buys when others are excited. An investor buys when others are afraid. A speculator defines success as selling higher than they bought. An investor defines success as owning a piece of a wonderful business that generates growing profits year after year. These are not just different strategies. They are different relationships with time, with uncertainty, and with the fundamental nature of what a stock actually is. Graham is relentless on this point. A share of stock is not a lottery ticket. It is not a piece of paper whose price goes up and down according to the moods of the crowd. A share of stock is a fractional ownership interest in a real business with real assets, real revenues, real employees, and a real future. When you understand that, everything changes. Graham introduces one of his most enduring and beloved mental models early in the book. He calls it Mr. Market, and it is one of the most useful ideas ever applied to financial thinking. Imagine, Graham says, that you are part owner of a private business, and your business partner, whose name is Mr. Market, has a peculiar emotional condition. Every single day, he comes to you and offers either to buy your share of the business or to sell you his share at a price he names. Sometimes Mr. Market is in a wonderful mood. He is optimistic and cheerful, and on those days he names an extremely high price because he believes the future is bright and wonderful things are coming. Other times, Mr. Market is gripped by fear and gloom. On those dark days, he names a very low price because he is terrified the business will fail and everything will collapse. The key insight Graham offers is this. Mr. Market is your servant, not your guide. His prices are an offer, not an instruction. You are under no obligation to sell to him when he is euphoric, and you are under no obligation to buy from him when he is depressed. But if you are wise, you will sell to him when he is being irrationally generous, and you will buy from him when he is being irrationally fearful. His moods create your opportunities, but only if you remain rational while he is not. Most investors do the opposite. They look at Mr. Market's mood and try to match it. When he is excited, they get excited. When he is afraid, they become afraid. They confuse his emotional swings with information, his volatility with intelligence. Graham says this is precisely backwards. Mr. Market's volatility is not information, it is noise. The business you own does not change its fundamental value because Mr. Market had a bad day. The earnings it generates, the products it sells, the customers it serves, all of that continues regardless of what price Mr. Market is willing to offer on any given Tuesday afternoon. If you can hold on to this mental model, if you can truly internalize it and feel it in your bones, you will be protected from the single greatest danger that faces every investor. That danger is not an economic recession or a stock market crash. It is yourself. It is the part of you that watches prices fall and wants desperately to sell. The part of you that watches prices rise and feels a compulsion to buy. The part of you that treats the market as a measure of your own intelligence and worth, rather than as an auction house where occasionally very good things go on sale. Graham divides all investors into two broad categories, which he calls the defensive investor and the enterprising investor. This division is not about how much money you have or how smart you are. It is about how much time, energy, and intellectual effort you are genuinely willing to devote to the task of managing your investments. The defensive investor, whom Graham sometimes calls the passive investor, wants a reasonable return without the work of active portfolio management. This is not laziness, Graham insists. This is wisdom. Knowing your own limitations and your own temperament is itself a form of intelligence. The defensive investor's strategy is simple, low-cost, diversified, and disciplined. It involves owning a broad mix of high-quality stocks and bonds, rebalancing periodically, and ignoring almost everything that happens in the financial news on any given day. The defensive investor does not try to beat the market. The defensive investor accepts the market's return and focuses instead on not doing anything foolish that would cause them to underperform the market through unnecessary trading, emotional decision-making, or chasing whatever investment story is currently generating the most excitement. The enterprising investor, by contrast, is willing to do serious homework. This investor is prepared to spend considerable time studying companies, reading financial statements, evaluating management teams, and searching patiently for situations where the market has mispriced a security. But Graham is careful to warn that the word enterprising does not mean aggressive or adventurous in the conventional sense. The enterprising investor is not the person who takes big swings on speculative bets, buys the hottest initial public offerings, or trades options based on short-term predictions about where interest rates are going. The enterprising investor is not more daring than the defensive investor. The enterprising investor is simply more hardworking. And that extra work must be genuinely rewarded with genuinely superior results, or it is not worth doing. Graham is direct about this. Most people who think they are enterprising investors are actually just speculating with extra steps. True enterprising investing requires discipline, patience, and an almost painful willingness to be out of step with the crowd. One of the most practically powerful concepts in the entire book is the margin of safety. This idea is so central to Graham's philosophy that Warren Buffett has described it as the three most important words in investing. The margin of safety is the gap between a stock's intrinsic value and the price you actually pay for it. Intrinsic value is what a business is truly worth based on its assets, its earnings, its future cash flows, and its competitive position. Price is what the stock market is asking you to pay on any given day. When price is well below intrinsic value, you have a margin of safety. You have cushion. You have room to be wrong, and in investing you will be wrong sometimes. Companies miss earnings forecasts. Industries face unexpected headwinds. Management makes mistakes. Economic conditions change. The margin of safety is your protection against all of the things you cannot know and cannot predict. It is the financial equivalent of building a bridge that can hold 20 tons when you only expect to drive 10 tons across it. You do not build that bridge because you expect the extra weight. You build it because the world is unpredictable and intelligent engineers account for what they cannot foresee. The margin of safety concept is elegant precisely because it reframes the entire act of investing. Most investors focus almost entirely on what might go right. They buy a stock because they believe the company will grow, the product will succeed, the stock price will rise. Graham asks you to focus on what might go wrong, and to ensure that you have paid a price low enough that even a disappointing outcome does not destroy you. This sounds pessimistic, but it is actually the most optimistic strategy of all, because it means you can participate in the upside of good businesses while protecting yourself from the full downside of bad outcomes. It means you do not need to be right every time. You do not need a perfect prediction. You just need a consistent discipline of buying below value and letting the gap between price and value do the work for you. The margin of safety is not a trick or a technique. It is a habit of mind. It is the investor's version of humility, the acknowledgement that no matter how smart you are or how carefully you have analyzed a situation, you could still be wrong, and you should price that possibility into every decision you make. Graham spends considerable time in the book discussing the psychology of the stock market, and this is where his wisdom feels most timeless. He lived through the crash of 1929, the Great Depression, the recovery, the post-war boom, multiple recessions, and countless moments of market hysteria, both upward and downward. From all of that experience, he drew a simple and uncomfortable conclusion. The main obstacle to intelligent investing is not a lack of information or a lack of analytical skill. The main obstacle is the investor's own emotional response to price movements. When prices are rising, investors feel confident and optimistic. They interpret rising prices as evidence that they made smart decisions, and they become willing to pay even higher prices. Not because the underlying business has become more valuable, but because the price going up feels like confirmation of their wisdom. When prices are falling, investors feel anxious and fearful. They interpret falling prices as evidence that something is wrong, and they become desperate to sell before things get worse. Not because the underlying business has deteriorated, but because the price going down feels like a threat to their identity and their financial security. Graham calls this the fundamental confusion between price and value, and he returns to it throughout the book with increasing urgency. The price of a stock and the value of the underlying business are related but not identical. In the short run, price is driven by emotion, momentum, news headlines, and the collective moods of millions of participants who are all trying to predict what everyone else will do. In the long run, price tends to converge on value because companies that generate real profits and grow their businesses eventually attract investors who recognize that and bid prices up, while companies that fail to generate real profits eventually see their prices fall no matter how exciting their story sounded at the beginning. The intelligent investor exploits this gap between short-term price and long-term value. The intelligent investor buys when short-term fear has pushed the price below long-term value, and sells when short-term excitement has pushed the price above long-term value. This sounds obvious. In practice, it is extraordinarily difficult because it requires you to consistently do the thing that feels most wrong in the moment. The book dedicates significant attention to the concept of stock selection for the defensive investor, and Graham's criteria are remarkably conservative by the standards of most modern investors. He recommends that the defensive investor focus on large, well-established companies with long records of profitable operation, strong financial positions, and histories of consistent dividend payments. He is not interested in exciting growth stories or transformative technologies. He is interested in boring, durable businesses that have proven over many years that they can generate consistent returns for their owners. This preference for the boring and the proven is not accidental. Graham understood something that many investors still resist, which is that the most exciting investments are usually the most dangerous ones. When everyone agrees that a company is wonderful and its future is bright, the price has already been bid up to reflect that optimism. There is no margin of safety in a company whose stock price already assumes perfection. The price already contains the good news. For the price to go higher, the news must be even better than perfect, and that is a very difficult bar to clear. Graham also addresses the question of bonds and asset allocation with characteristic pragmatism. He does not believe in rigid rules about how much of your portfolio should be in stocks versus bonds at any given time. He does believe that most investors should always hold some meaningful percentage in both. He suggests, as a rough starting point, that a conservative investor might hold 50% in bonds and 50% in stocks, adjusting within a range of 25 to 75% in either direction depending on valuations and personal circumstances. When stocks have risen sharply and appear expensive, moving toward the bond end of that range makes sense. When stocks have fallen and appear cheap, moving toward the stock end makes sense. This is a mild form of contrarian allocation, a systematic way of doing more of what is unpleasant and less of what feels good, which is precisely the mental posture that leads to superior long-term results. One of the most important and most frequently ignored chapters in the book deals with the investor's relationship to investment advisors and financial intermediaries. Graham is not hostile to professionals. He is realistic about them. He understands that most people who enter the financial services industry do so with genuine intentions, but he also understands that the incentives of the industry do not always align with the interests of the client. Advisors are paid, in many cases, based on how much activity they generate in your account, how many transactions they facilitate, how many products they sell. This creates a structural conflict between what is good for you and what is profitable for them. Graham does not say you should never use an advisor. He says you should understand this conflict, ask the right questions, and never surrender your own judgment entirely to someone else simply because they have more information than you do or speak with more confidence. Your money is your responsibility. Understanding the basic principles of its management is not optional. It is the minimum requirement of financial adulthood. Graham also writes with striking clarity about the dangers of market timing, the idea that you can improve your returns by predicting when the market is about to rise or fall and moving your money accordingly. This idea is seductive because it sounds rational. If you know the market is about to drop, you should sell everything and wait. If you know it is about to rise, you should be fully invested. The problem, Graham points out, is that nobody knows these things with any consistency. The history of market timing is a history of confident predictions made by intelligent people who turned out to be wrong often enough that the strategy reliably underperformed simple buy-and-hold investing. The reason is not that the predictors were unintelligent. The reason is that markets are systems of enormous complexity, influenced by variables that cannot all be known simultaneously. Even when you are right about the economic fundamentals, you may be wrong about the timing. The market can stay irrational far longer than any individual can stay solvent or patient. The chapter on the history of stock market fluctuations is one of the most important in the book because it provides the historical context that most investors desperately need and almost never bother to acquire. Graham walks through the major market cycles of the early 20th century, showing how booms are followed by busts, how pessimism eventually gives way to optimism, how the recovery that everyone said would never come eventually comes, and how the crash that everyone said could never happen eventually happens. He does this not to predict future cycles, but to inoculate the reader against the dangerous delusion that current conditions are permanent. In every bull market, investors begin to believe that this time is different, that the old rules no longer apply, that the companies driving the market higher are genuinely worth the astronomical prices being paid for them. And in every bear market, investors begin to believe that the decline is permanent, that the economy will never recover, that stocks are fundamentally dangerous and sensible people should avoid them entirely. Both beliefs are wrong. Both beliefs destroy wealth. The only protection against them is historical knowledge and the discipline to remember it when your emotions are screaming at you to do something that history says you will regret. Graham's discussion of growth stocks is particularly sharp and worth careful attention. Growth stocks are companies that are growing their revenues and earnings faster than the overall economy, and they have a natural appeal to investors because their futures seem brighter than average. The problem Graham identifies is that by the time a company's growth is obvious enough for most investors to recognize it, the stock price has usually already risen to reflect that expected growth. You are not paying for the company as it is today. You are paying for the company as it is expected to be in 5 or 10 years. And if those expectations are already embedded in the current price, you need the company to actually exceed those already optimistic expectations just to earn a normal return. This is a much harder task than it sounds. Most companies that look like obvious winners at the peak of their popularity fail to live up to the extraordinary expectations that have been priced into their shares. Not because they are bad companies, they may be wonderful companies, but wonderful companies purchased at wonderful prices produce disappointing investment results because the price has already consumed all of the future value you hope to capture. The book addresses the concept of dollar-cost averaging, a practice that is particularly relevant for ordinary investors who are building wealth over time through regular savings. Dollar-cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. This approach has a beautiful mathematical property. When prices are low, your fixed amount buys more shares. When prices are high, your fixed amount buys fewer shares. Over time, you automatically accumulate more shares at low prices than at high prices, which means your average cost per share tends to be lower than the average price over the same period. More importantly, dollar-cost averaging removes the destructive emotion from the process. You are not trying to pick the perfect moment to invest. You are simply investing consistently, systematically, regardless of whether the news is good or bad, regardless of whether Mr. Market is euphoric or despairing. This mechanical discipline is, Graham suggests, one of the most effective things an ordinary investor can do to improve their long-term results. Graham also addresses the important topic of dividend income and its role in the total return of equity investing. He is a great admirer of dividends, not merely because they provide income, but because they serve as evidence of real profitability. A company that pays a consistent and growing dividend is making a public commitment. It is saying that its profits are real, that its cash flows are genuine, and that it is willing to return value to shareholders in a tangible, concrete form. Dividends are hard to fake. Earnings can be manipulated through accounting choices. Cash dividends require actual cash. For Graham, a long record of consistent dividend payments is one of the most reliable signals of financial health and management integrity available to outside investors. He is skeptical of companies that retain all of their earnings, not because retained earnings are bad, but because the history of corporations is littered with examples of retained earnings being wasted on empire building, vanity acquisitions, and misguided expansion that destroyed rather than created value for shareholders. The section on evaluating management is one of the wisest and most underappreciated parts of the book. Graham understands that the ultimate quality of any investment depends heavily on the quality of the people running the business. But he also understands that evaluating management is extremely difficult from the outside. Executives are skilled at presenting themselves favorably. Annual reports are written to reassure shareholders, not to reveal problems. Press releases emphasize the positive and minimize the negative. How, then, does an outside investor form a realistic assessment of whether the people running a company deserve trust? Graham offers several practical tests. Does the company allocate capital wisely, meaning does it invest in things that generate returns greater than the cost of that capital? Does management communicate honestly about failures as well as successes? Does the company buy back stock when the price is low, rather than when it is high, suggesting that management genuinely understands the relationship between price and value? Does the company compensate executives reasonably, or does it treat executive compensation as a way to transfer wealth from shareholders to managers? These are not perfect tests, and none of them is individually conclusive. But taken together, they give an alert and attentive investor a reasonable basis for judgment. One of the most controversial and challenging aspects of Graham's philosophy, at least by the standards of modern financial theory, is his rejection of the efficient market hypothesis. Modern academic finance has argued, with considerable mathematical sophistication, that markets are efficient, meaning that all available information is already reflected in stock prices. If this were true, then no amount of analysis could give any investor a consistent edge, because any insight you develop would already be priced in by the time you acted on it. Graham's entire career was a refutation of this idea, and he rejected it not with theoretical arguments but with practical results. If markets were truly efficient, Graham's own investment record would be impossible. If markets were truly efficient, the investment records of the many investors who explicitly followed Graham's methods, including Buffett and others in what Buffett has called the super investors of Graham and Doddsville, would be impossible. What Graham observed, and what decades of subsequent evidence have confirmed, is that markets are efficient much of the time, but not all of the time. And in the gaps between what markets price and what businesses are actually worth, patient and disciplined investors can find genuine, repeatable opportunities to earn superior returns. Graham writes with genuine empathy for the ordinary investor, the person who is not a financial professional, who does not have a team of analysts or access to management meetings, who is simply trying to build a secure financial future by saving money and investing it wisely. He never talks down to this person. He never pretends that the subject is too complex for non-experts to understand. He believes, and argues persuasively, that the fundamentals of intelligent investing are accessible to any thoughtful person who is willing to do some reading and some arithmetic and who has the emotional discipline to act on their analysis rather than on their feelings. The barriers to intelligent investing, Graham repeatedly demonstrates, are not intellectual. The barriers are behavioral. The enemies of the intelligent investor are not difficult equations or complex accounting principles. The enemies are impatience, overconfidence, the desire to feel clever, the inability to tolerate short-term loss in pursuit of long-term gain, and the very human tendency to confuse activity with progress. The commentary provided by Jason Zweig, which accompanies the most widely read modern edition of the book, serves to translate Graham's timeless principles into contemporary examples, and this combination of original wisdom and modern illustration gives the book a remarkable freshness. Zweig draws parallels between the speculative excesses Graham described in the 1920s and 1930s and the dot-com bubble of the late 1990s, between the market panics of Graham's era and the financial crisis of 2008, between the investment fads Graham warned against and the cryptocurrency mania and meme stock phenomenon of the early 21st century. The details change. The human psychology does not. Every generation of investors arrives believing that this time is different, that the new technology or the new financial instrument or the new economic paradigm has changed the rules. Every generation discovers, sooner or later, that the rules have not changed. That value matters. That price relative to value matters. That emotional discipline matters. That patience matters. These lessons are not exciting. They do not make for compelling television. They do not generate clicks or likes or shares, but they generate wealth, steadily, reliably, compounding year after year in the accounts of the people who have internalized them and found the discipline to act on them consistently. Graham's chapter on the investor and market fluctuations is perhaps the most elegantly written in the book, and it contains a passage that every investor should memorize and recite to themselves during every market downturn. He argues that the intelligent investor should think of market fluctuations as his friend rather than his enemy. When prices fall, the intelligent investor does not despair. The intelligent investor gets excited, the way a sensible shopper gets excited when a store they love announces a sale. When the grocery store cuts the price of pasta by 40%, you do not conclude that pasta has become a worse food. You conclude that you should buy more pasta than usual and be grateful for the opportunity. The same logic applies, Graham insists, to stocks. When the market cuts the price of a wonderful business by 40%, not because the business has deteriorated, but because Mr. Market is having a crisis of confidence, the intelligent investor should reach for their checkbook, not their phone to call their broker and sell. This analogy is simple. It is even a little silly. But Graham uses it deliberately because the silliness is the point. The emotional response that causes most investors to sell during downturns is just as silly as a shopper who decides to stop buying groceries because prices have fallen. The book's treatment of bonds and fixed income investing reflects Graham's era, but its principles translate directly to any era. He emphasizes that the bond portion of a portfolio serves a specific purpose, which is not to generate maximum returns, but to provide stability, predictability, and a source of funds to draw on when equity prices are depressed. This psychological function of bonds is at least as important as their financial function. If your portfolio is 100% equities and the market falls by half, the temptation to sell everything and stop the pain can become overwhelming. But if you hold a meaningful allocation in bonds that has not fallen with the equity market, you have several options that are unavailable to the fully invested equity holder. You can rebalance, selling bonds that have held their value to buy stocks that have become cheap. You can draw on your bond allocation for living expenses, allowing your stocks to recover without being forced to sell at depressed prices. You can simply look at your overall portfolio and observe that it has not fallen as much as the equity market, which reduces the emotional pressure to do something rash. Bonds, in Graham's framework, are insurance against your own worst instincts. The concept of formula investing, which Graham discusses at some length, is related to but distinct from dollar cost averaging. Formula investing refers to any systematic rule-based approach to investment decisions that removes or reduces the role of individual judgment and emotion. Graham is broadly sympathetic to formula investing, not because he thinks formulas can capture all of the relevant information about a situation, but because he knows from painful experience how badly individual judgment tends to perform under pressure. A rule that says you will always hold between 25 and 75% in stocks, and that you will rebalance whenever your allocation drifts more than 5% from your target, is not a perfect investment strategy. But it is a reliable one. It forces you to buy more stocks when they are cheap and fewer when they are expensive. It prevents you from making the catastrophic mistake of going to 100% stocks at market peaks and 0% stocks at market bottoms, which is exactly what most investors do when they trust their instincts rather than their rules. Graham's analysis of the difference between a good company and a good investment is one of the most intellectually clarifying distinctions in the book, and it is one that many investors never fully grasp. A good company is one with strong competitive advantages, talented management, growing revenues, expanding profit margins, and a bright future. A good investment is one that you purchase at a price that gives you an attractive return relative to the risk you are taking. These two things can coincide, but they do not always coincide. In fact, some of the best companies in the world are, at certain points in time, among the worst investments you can make, simply because their prices reflect not just their current excellence, but an optimistic assumption about many years of future excellence that may or may not materialize. Conversely, some mediocre companies are, at certain points in time, excellent investments, simply because their prices have fallen so far below even a pessimistic assessment of their true worth that even a modest recovery produces excellent returns. Separating the quality of the business from the quality of the price is, for Graham, the central intellectual task of investment analysis. The intelligent investor does not look for excitement. The intelligent investor looks for mispricing. The intelligent investor is not trying to find the most wonderful company in the world. The intelligent investor is trying to find the company whose price is most inconsistent with its actual value. This might be a wonderful company going through a temporary crisis. It might be a boring, unfashionable company in an industry that nobody is currently excited about. It might be a company whose most recent earnings disappointed expectations and whose stock has been sold off by investors who confuse a short-term disappointment with a long-term impairment of value. In all of these cases, the opportunity exists not because the business is glamorous, but because the price is wrong, and eventually prices that are wrong get corrected by the relentless arithmetic of compounding value. Graham is deeply interested in the financial structure of the companies he analyzes, and he devotes considerable attention to the reading and interpretation of financial statements. He is not simply interested in earnings per share, the single number that most financial journalists focus on when reporting on a company's quarterly results. He wants to understand the quality of those earnings. Are they backed by real cash flows, or have they been inflated through accounting choices that will eventually reverse? Is the company carrying excessive debt that could become dangerous in a downturn? Does it have enough liquid assets to survive a period of adversity without needing to raise emergency capital at unfavorable terms? Is the growth in earnings being achieved by reinvesting profits intelligently? Or is it being purchased through acquisitions that dilute shareholders or load the balance sheet with goodwill that may never be recoverable? These questions require work. They require reading past the headline numbers and understanding the footnotes. They require a willingness to do the arithmetic, to build simple models, to ask uncomfortable questions rather than accepting the story management is trying to tell. This is what Graham means by thoroughness, and it is the intellectual foundation upon which the margin of safety is calculated. The chapter on the investor and inflation is remarkably prescient. Graham understood that inflation is a silent tax on wealth, that it erodes the purchasing power of savings over time, and that investors who focus exclusively on nominal returns without considering real, inflation-adjusted returns are operating with a dangerously incomplete picture of their financial progress. He was also honest about the limited protection that stocks actually provide against inflation, pushing back against the then common wisdom that equities are always a reliable inflation hedge. Stocks can and do lose real value during inflationary periods, particularly when inflation leads to higher interest rates, which in turn increase the discount rate applied to future earnings and push stock valuations down. Graham's prescription is not to avoid stocks because of inflation risk. It is to hold a diversified portfolio, to focus on companies with real pricing power, meaning companies that can raise their prices without losing customers, and to be realistic about the limitations of any single asset class as a complete solution to the problem of inflation. As the book moves toward its conclusion, Graham returns to the theme that runs through every chapter and every argument, which is the primacy of the investor's own psychology in determining their investment outcomes. He has given the reader tools, frameworks, formulas, and principles. But he knows from decades of watching investors succeed and fail that the tools are only as useful as the emotional discipline of the person wielding them. The best investment strategy in the world is worthless if you abandon it during the first market crash. The most carefully constructed portfolio produces no benefit if you sell it in a panic because the financial news has become terrifying. The margin of safety protects you from nothing if you override it every time an exciting story makes you want to pay more than a company is worth. The fundamental challenge of investing is not analytical, it is psychological. And the fundamental solution to that challenge is not finding better data or better algorithms. It is developing a clear and honest understanding of your own emotional tendencies and building an investment process that protects you from yourself. Graham closes his book with a meditation on the relationship between investment and life philosophy that feels deeply personal, shaped by his own experience of watching his own financial situation, built with such care and intelligence, be nearly destroyed by market forces beyond his control, only to be rebuilt through the application of the very principles he is now sharing with his readers. He does not pretend that following his approach guarantees a smooth ride or eliminates all losses. He does not promise that the disciplined investor will never experience anxiety or regret. What he does promise, with the quiet confidence of someone who has tested these ideas against decades of real market experience, is that the investor who applies these principles consistently will do better than the investor who abandons them whenever they become uncomfortable. Not in every quarter, not in every year, but over the kind of long-time horizons that actually matter for building lasting financial security. The Intelligent Investor is not a book about getting rich quickly. It is a book about getting wise slowly. It is about the development of judgment, patience, and emotional maturity in the context of financial decision-making. It is about learning to think probabilistically rather than deterministically, to evaluate outcomes in terms of expected value rather than hoped-for results, to make decisions based on analysis rather than emotion, to embrace uncertainty rather than pretending it can be eliminated. Graham treats his readers as adults who are capable of understanding complexity and tolerating ambiguity, and who deserve to be told the truth about what investing actually involves, rather than being entertained with stories about easy money and magical formulas. This respect for the reader is one of the most appealing qualities of the book, and one of the reasons it has retained its relevance across more than 7 decades of dramatic change in financial markets, economic conditions, and investment technology. The world of investing has changed enormously since Graham first published his ideas. The rise of index funds, which did not exist in Graham's era, has made it easier than ever for ordinary investors to capture market returns at very low cost, and Graham would surely have endorsed this development as consistent with his advice to the defensive investor. The rise of behavioral finance as an academic discipline has confirmed and extended many of Graham's psychological insights with rigorous empirical research that was not available in his time. The globalization of financial markets has created new opportunities and new risks that Graham could not specifically anticipate. The digitization of financial information has made it both easier to access the data needed for fundamental analysis and easier to be overwhelmed by the noise that drowns out the signal in that data. All of these changes are real and important. None of them has altered the fundamental truth at the heart of Graham's philosophy. Markets are driven in the short run by emotion and in the long run by value. The gap between emotion and value is where intelligent investors find their opportunities. and the discipline required to consistently exploit that gap is available to anyone who is willing to develop it. The tools are not secret. The information is not hidden. The only thing standing between most investors and the results Graham describes is themselves, and the willingness to study, think, and exercise the kind of patient, rational discipline that Graham spent his entire career trying to teach. Benjamin Graham did not write The Intelligent Investor to make himself famous or wealthy. He wrote it because he genuinely believed that the principles he had developed could help ordinary people build financial security, and because he was troubled by the damage he had watched careless speculation do to the lives of real people who could not afford the losses they suffered. That combination of intellectual rigor and human compassion gives the book a warmth that is unusual in financial literature. Graham is not lecturing. He is teaching. He is not showing off. He is explaining. He is not trying to impress you with his sophistication. He is trying to equip you with the understanding and the tools you need to make better decisions with your own money for the rest of your life. And in that ambition, this remarkable book, written by a man who had seen more of the market's capacity for cruelty and generosity than almost anyone alive, succeeds completely. If you read only one book about investing in your entire life, read this one. Read it slowly. Read it more than once. Read it during the next market crash when everything Graham warned you about will be happening in real time and when everything he taught you will be the only thing standing between you and a decision you will regret for years.